Watching the monthly CBN's monetary policy meeting going on right now in Lagos, with being chaired by the CBN governor, Godwin Emefiele.
The committee noted with concern the downtrend in global recovery, aggravated by supply chain disruptions as a result of Russia-Ukraine conflict and the spillbacks and spillovers from sanctions imposed on Russia by the US and its allies. This has resulted in an unprecedented rise and widespread global inflation, which is exacerbating downward pressure on the fragile recovery of the global economy. In addition, lingering headwinds associated with COVID-19 pandemic are constraining the smooth functioning of the global supply chain. The rising risk of tightening global financial conditions implies that developing economies now face the risk of constrained access to global capital, which would further depress growth in this group of economies. This is expected to result in increased financial vulnerabilities due to the huge volume of corporate and public debt accumulated in the wake of the sharp downward downturn driven by COVID-19 lockdowns. In the light of these developments, the key risk confronting the global economy is that of a recession, which may crystallize as second quarter growth figures for major advanced and developing economies begin to emerge. Consequently, the IMF in its April 2022 World Economic Outlook wheel downgraded its global output growth forecast for 2022 and 2023 to 3.6% apiece from 4.4% and 3.8% respectively, with the likelihood of a further downgrade given the continued deterioration in output. Inflation in several advanced economies pushed further higher and further away from the long-run objectives of their central banks, reflecting the sustained increase in the price of food, energy, and other commodities due to the harsh combination of persisting supply chain disruptions and pent-up demand. In the emerging markets and developing economies, inflation is also on the rise, compounded by legacy structural challenges as well as heightened exchange rate pressures driven by rising capital flow reversals, in addition to the outlined shocks from the global economy. In the financial markets, available data suggests that investors are now rebalancing their portfolios away from gold and equities to fixed income securities to take advantage of rising yields in the advanced economies as major central banks progress with interest rate lift-off. Consequently, the tightening of global financial conditions is expected to heighten investment and debt default risks, leading to likelihood of a broad economic slowdown. Domestic economic development. According to National Bureau of Statistics, NBS, real gross domestic product GDP grew by 3.11% year-on-year in the first quarter of 2022, compared with 3.98% and 0.51% in the corresponding period of 2021. The economy has thus grown for 6 consecutive quarters following its exit from recession in 2020. This consistent positive performance was driven largely by the continuous growth in the non-sector, specifically in the services and agriculture subsectors, ongoing policy support post-COVID lockdowns, and the base effect from the corresponding period. Star projections show that the economy is expected to remain on a path of sustained positive growth observed in the last few quarters. The committee also noted that both the manufacturing and non-manufacturing purchasing managers indices increased above the 50 index point benchmark to 51.1 and 50.3 index points in June 2022, compared with 48.9 and 49.9 index points respectively in May 2022. This reflects the continued rebound in economic activities due to improvements in supplier delivery times, raw materials inventory, and employment levels as well as expansion in some sectors such as agriculture, accommodation, electricity, among others. Committee noted with concern the persistent uptick in headline inflation year-on-year to 18.6% in June 2022 from 17.71% in May 2022, an 89 basis points increase in just a month. This continued increase in inflation was driven by increases in both the core and the food components to 15.75 and 20.6% in June 2022. This considerable rise in core inflation resulted largely from the rising cost of production due to high energy prices associated with the persistent disruptions to power supply, hike in electricity tariff, continued scarcity of petroleum motor spirit PMS, and rising price of automatic gas oil AGO. The increase in the food component was, however, driven by shocks to food prices associated with continued insecurity in food production and along major access routes across the country, the continued impact of the war in Ukraine on the supply of fertilizer inputs, wheat and other grains, exchange rate pressures, and the impact of monetary policy normalization on capital flows away from emerging markets. The committee, however, expressed confidence in the bank's sustained intervention programs, noted that inflation is expected to abate as food supply improves and the fiscal authorities sustain its efforts to tame the legacy structural challenges which put upward pressure on domestic price levels. Members therefore urge the fiscal authority to expand recently deployed stimulus to the real sector of our economy. The Monetary Policy Committee noted that broad money supply M3 rose significantly to 11.52% in June 2022 compared with 10.86% in May 2022. This was largely driven by the growth in net domestic assets NDA of 18.02% in June 2022 compared with 17.37% in the previous month. The sustained growth in net domestic assets was attributed to the increase in claims on sectors, in this case public, non-financial corporations, private sector, and state and local government. Money market rates oscillated above and below the asymmetric corridor, reflecting prevailing liquidity conditions in the banking system. Consequently, the monthly weighted average open buyback rate OBB and interbank call rate increased in June 2022 to 10.89 and 11.1% from 9.39 and 8.38% in May 20 respectively. The increase in both the open buyback and interbank call rate reflected the tight liquidity conditions in the banking system. Capital adequacy ratio and the liquidity ratios both remained above the prudential limits of 14.1 and 42.6% respectively in June 2022. Committee, however, noted with concern the slight uptick in non-performing loans ratio of 5% in June 2022 and 7% in June 2021. The MPC thus urged the bank to sustain its tight prudential regime to ensure that NPL ratio is brought well below its prudential benchmark. MPC noted the very moderate decline in the performance of the equities market in the review period as the all-share index and the market capitalization moderated to 51,817.59 and 27.94 trillion naira on June 30, 2022, from 52,990.78 and 28.56 trillion naira on May 31, 2022, respectively. The market, however, remains resilient, reflecting continued confidence in the Nigerian economy as both the monetary and fiscal authorities work assiduously to improve macroeconomic fundamentals in Nigeria. Committee noted the marginal increase of 1.61% in the level of external reserves to $39.22 billion at the end of June 2022 from 38.360 billion at the end of May 2022 due to increase in flows from non-oil sources. The committee reviewed the performance of the bank's intervention programs targeted at stimulating productivity in agriculture, manufacturing industries, energy and infrastructure, healthcare, exports, and micro, small, and medium enterprises between May and June 2022. Under the Anchor Borrowers Program, for instance, the bank released the sum of $3.62 billion as disbursements to 12 projects for the cultivation of rice, wheat, and maize, bringing the cumulative disbursements under the program to 1.01 trillion naira to over 4.21 million smallholder farmers cultivating 21 commodities across the country. The bank also disbursed 3.72 billion to finance 3 large-scale agricultural projects under the Commercial Agricultural Credit Scheme. These disbursements bring the cumulative disbursement under this scheme to 744.32 billion naira for 678 projects in agro-production and agro-processing. As part of its efforts to support the manufacturing sector, the CBN disbursed the sum of 113.08 billion naira to 19 new projects under the real sector facility. The funds were utilized for both greenfield and brownfield projects under the COVID-19 intervention for the manufacturing sector and the real sector support facility from differentiated CRR DCRR. Cumulative disbursement under the real sector facility currently stands at 2.183 trillion naira for the financing of 414 real sector projects across the country. Furthermore, under the 100 for 100 policy on production and productivity, the bank has released 9.98 billion naira to 5 projects, bringing the cumulative disbursements under the intervention to 68.13 billion naira to 48 projects comprising 26 in manufacturing, 17 in agriculture, 3 in healthcare, and 2 in the services sector. Under the healthcare sector, the bank disbursed 4.44 billion naira to 3 healthcare projects under the Healthcare Sector Intervention Facility, bringing cumulative disbursements to the healthcare sector to 133.42 billion for 129 projects comprising 76 hospitals, 32 pharmaceuticals, and 21 other healthcare services. To further expand the nation's non-oil export basket under the Export Facilitation Initiative, the bank released the sum of 36 billion naira for 5 projects in domestic production and value addition of cocoa, sesame seeds towards improving non-oil foreign currency revenues. To improve electricity supply, in order to lower the overall cost of production in the real sector, the bank also intervened in the power sector to facilitate deployment of enabling infrastructure. Summarily, the sum of 2.53 billion naira was disbursed to DISCOs for the operational expenditure, OPEX, and CAPEX under the Nigerian Electricity Market Stabilization Facility, Phase 2. Cumulative disbursement under the NEMS 2 currently stand at 254.46 billion naira, 6.4 billion naira. Under the National Mass Metering Program, the bank disbursed 47.82 billion naira for the procurement and installation of 865,956 meters across the country. The outlook. The broad outlook for both the global and domestic economies in medium term remain clouded with uncertainties associated with headwinds such as the substantial disruptions to supply chain, the Russia-Ukraine war, and the lingering impact of COVID-19 pandemic. Others include the rise and public debt in the advanced economies and emerging market and developing economies, as well as the broad shocks to foreign capital flows driven by the aggressive normalization of monetary policy in some of the advanced economies. On the domestic front, available data on key macroeconomic variables indicate the likelihood of a subdued output growth for the Nigerian economy in 2022. This is hinged on the ongoing and expected shocks from the global economy, particularly from supply blockages of essential exports from both Russia and Ukraine, the impact of high crude oil prices given Nigeria's position as an oil exporter and importer of refined petroleum products, and the aggressive normalization by some advanced economies. Accordingly, the Nigerian economy is forecast to grow in 2022 by 3.3% CBN estimate, 4.2% federal government estimate, and 3.4% IMF estimate. The committee's consideration. Committee assessed the impact of emerging external shocks and legacy issues on price development and the recovery of output growth in the short to medium term. Members further noted the continued effort by both the monetary and fiscal authorities to dampen price pressures and sustain the recovery of output growth. In the opinion of our members, the major external shocks to the economy remained those associated with supply constraints arising from the Russia-Ukraine war and backlash from sanctions imposed on Russia, residual impact of COVID-19 pandemic, and tightening external financial conditions, particularly global financial markets, following the aggressive normalization of monetary policy by some advanced economy central banks. On the domestic scene, members assessed the impact of the continued upsurge in money supply resulting from the increased demand, election spending, and increase in month-on-month inflation between May and June 2022. In addition, the committee assessed the continued impact of rising insecurity, the rising cost of automatic gas oil AGO, and the persistent upward pressure on other energy prices on the general price level. MPC noted that the current upsurge in price levels remain a primary concern to monetary policy, as members focused on the optimal policy approach required to address this development while protecting our fragile economy. The committee clearly identified that inflationary pressure was being driven by both demand and supply side factors, which should be addressed using different policy approaches. In the committee's view, the demand side factors were being broadly addressed by the bank using the relevant direct and indirect instruments. On the supply side, the bank has continued to provide the necessary support through its development finance initiatives in the real sector to ease supply constraints. The committee called on the federal government to prioritize efforts to curb the menace of insecurity to enable farming and other business activities return to normalcy. The MPC thus called on the bank to continue its investments towards increasing food supply in a bid to addressing food inflation. Members also noted the upward price pressure, particularly on transportation, resulting from the prolonged scarcity of premium motor spirit PMS, and called on the federal government to seek a long-term and viable solution to strike a balance between the pricing and supply of PMS in Nigeria. The committee appraised the continued recovery of output growth, noting that despite the obvious external and internal headwinds, the recovery has remained resilient with hopes of a stronger medium-term recovery. This, however, hinged on the continued support by the bank and the federal government to ensure that recent economic gains are indeed sustained. MPC welcomed the bank's concerted efforts towards ensuring exchange rate stability, noting the current difficulties associated with managing the stream of external shocks impacting the economy. The committee applauded the performance of the RT200 and similar initiatives targeted at improving accretion to results and stabilizing the exchange rate. The MPC noted that foreign exchange inflow through the RT200 FX program during the first quarter and the second quarter of 2022 had increased substantially to almost $3 billion as of June 2022. Members also noted the increase in diaspora remittances as a result of the Naira for Dollar incentive and urged the bank not to relent in its efforts to encourage foreign exchange inflow into the country. The committee noted the federal government's increasing debt profile and expressed concerns over debt sustainability given that global uncertainties remain elevated. MPC thus reiterated its call to the federal government to urgently diversify its revenue sources through various initiatives such as the development of a viable tax framework for the extractive and mineral export industries to strengthen its fiscal buffers. Despite the apparent headwinds confronting the economy, the MPC noted that the banking system remained robust given the continued decline in NPLs below the prudential threshold and enjoined the bank to sustain the trend by maintaining its vigorous surveillance to ensure continued resilience of the banking system. The committee's decision. MPC noted with concern the continued aggressive movement in inflation even after the rate hike at its last meeting and expressed its unrelenting resolve to restore price stability while providing the necessary support to strengthen our fragile economy. As regards the decision as to whether to tighten, loosen, or hold, members were unanimous and so did not consider both loosening and retaining rates at existing levels at this meeting. This is because on loosening, the MPC felt loosening will worsen the existing liquidity condition in the economy and further dampen money market rates necessary to stimulate savings and investments. Members also felt that loosening would trigger the weakening of the exchange rate, which could pass through to domestic prices. MPC did not also consider holding rates constant because a hold stance may suggest that the bank is not responding sufficiently to both the global and domestic price developments as inflation numbers continue to trend aggressively upwards. And as regards tightening policy stance, members were unanimous that given the aggressive increase in inflation, coupled with the resultant negative consequences, particularly on purchasing power of the poor, as well as retarding growth, there is the need to continue to tighten. However, the policy dilemma was hinged around the level of tightening needed to rein in inflation without dampening manufacturing output, which could result from the higher cost of borrowing. Aside from narrowing the negative real interest rate gap, members were also of the view that tightening would signal a strong determination of the bank to aggressively address its price stability mandate and portray the MPC's sensitivity to the impact of inflation on the vulnerable households and the need to improve their disposable income. Members also noted that the last 150 basis points hike by the committee in May had not permeated enough in the economy to halt the rising trend in inflation and noted that the month-on-month percentage point increase in headline inflation rose sharply in June 2022 compared with May 2022. MPC also noted that other complementary administrative measures deployed by the bank to address the growth in money supply did not moderate the inflationary trend. Addressing the balance of policy objectives and developments in the global and domestic environment, the committee resolved that the most rational policy option would be to further strengthen its tightening stance in order to effectively curtail the unabated rising trend of inflation. Members were conscious of the fact that output growth remained fragile. However, not containing inflation now could erode the moderate gains achieved in improving consumer purchasing power and thus worsen poverty levels for the vulnerable populace. To ensure that output still remains in focus, MPC advised the bank's management to continue to use its development finance tools to support the agricultural and manufacturing sectors in Nigeria. Committee thus voted unanimously to raise the monetary policy rate, MPR. One member voted to increase the MPR by 150 basis points. 6 members by 100 basis points. 1 member by 75 basis points, and 3 members by 50 basis points. Consequently, committee resolved to increase the MPR by 100 basis points from 13% to 14%. And in summary, MPC voted as follows. 1. Increase MPR to 14% from 13%. Symmetric corridor at plus 100 and minus 700 basis points around the MPR. 3. Retain the CRR at 27.5%. And 4. Retain liquidity ratio at 30%. Thank you for your attention.
Thank you, Governor. That was the communique of the 286th meeting of the Monetary Policy Committee of the Central Bank of Nigeria, holding today, Tuesday, the 19th of July, 2022. Now, we will give the gentleman of the press a chance to answer a couple of questions. Now, tell us your name, as you represent, and then the question.
Thank you. My name is Collins Kwesi. I write for the Nation. My question is on inflation, which has continued to go up. Mr. Governor, the last NBS statistics show that March inflation was at 15.92, then in April it moved to 16.82, and now 18.60 in June. Will you tell us the efforts you need to take to reduce this inflation and to reduce the impact on average Nigerians? Thank you.
Good afternoon, Mr. Governor. My question is on RT 200. In your last MPC, you mentioned that you have been discussed about 3 billion in rebates on non-oil exports. Can you give us an update on that? And also, can you give us an update on the performance for 100-400 policy? And also, can we expect more inflows in remittances? Thank you.
What's the name?
Numa AKB,
this day.
Good afternoon. My name is Bukola Ido. I write for Leadership newspaper. I'd like to have an update on the e-Naira. I know it's targeted at improving financial inclusion in the country, and we've been told that there will be updates on it. So I'd like to know the update on the e-Naira, how far it has gone, particularly concerning the USSD. Also, I would like to know how much has been, you mentioned that the Naira for dollar has increased remittances. How much has the CBN been able to bring in through the Naira for dollar?
Okay, Governor, I have 2 questions from Abuja. This one is coming from Abu Wahab. It's New Telegraph. They said, now that the election period is upon us, what is the CBN doing to ensure that the Naira maintains its value in the face of allegations that politicians are still mopping up their campaigns? And the next question is coming from Sunday Michael, Daily Trust. You have listed a series of interventions that the bank has made, particularly in the agricultural and health sectors of the economy. Many are keen to know the impact of these interventions and the status of repayments by beneficiaries. That's it. Okay, maybe perhaps we just take one more question.
I'm Kiru Mokedi. I report for AIT. My question is just on the intervention. Now, at the weekend, major news at the weekend was that the Vice President had a successful surgery in Lagos. And I know that CBN has been talking more about patronizing local industry and then patronizing made in Nigeria. Now with this, how do you really feel about this? That's going to hospital in Nigeria instead of traveling abroad. How will this really help impact on medical tourism and behavior and conservation of effects in Nigeria? Are we really expecting more intervention in the health sector? Thank you, sir.
Thank you, thank you, thank you.
I think that's what we can take. Thank you.
Regarding what, the fact Wednesday says that inflation has been trending very aggressively from March to April and now at 18.6. And what are we doing, or what are we going to be doing to reduce the impact on the ordinary Nigerians? The truth is that, as we all know, inflation can be a terrible scourge. And what that means is that it's capable of totally obliterating the purchasing power of citizens of a country, particularly the weak and the vulnerable and the poor. Inflation, by the time it weakens the purchasing power of the vulnerable, naturally will also lead to heightened unemployment and would ultimately retard growth. Like you've all noticed, globally since the beginning of the year, there has been heightened level of inflation all over the world, to the extent that today we see, even in developed economies, the fact that as a result of even the rising inflation, supply chain problems and the rest of them, even most of those developed economies are already facing a threat of recession. Both the US, the EU, and some other economies suffered massive declines in their output. In the US, it was a negative output in the first quarter, and the fear is that if the United States witnesses a second decline during the second quarter of 2022 in output, naturally it means that the US will also be going into recession. And the expectation, unfortunately, the fear is that this may happen after the second consecutive negative output of the United States. And that is the reason why when we come sometimes to the MPs and say that we have to be very careful about the rate of acceleration in prices or inflation, it is a very serious matter that monetary policy committee members take very seriously, because what you find is that as inflation continues to trend aggressively higher, it will now begin to retard growth in any economy. And that's why, like you may have observed, most of the countries of the world, both the developed and developing economies, have had to embark on very aggressive rate increases so as to dampen. For instance, this year alone, the US Fed, the FOMC, has increased rates 4 times. It is because inflation in the US in 2020 was 2.5%. As at this time that we speak, the last numbers released, US inflation is 9.1. In the EU, I'm also sure that they have been hiking rates since the beginning of the year, at least by more than 2 or 3 times. Inflation has moved up from about 1.4% in 2020 to 8.6% in 2022. In Brazil, they have increased rates this year 5 times, which is like an average of a monthly increase in interest rates. and their inflation has moved up from 4.2% in 2020 to 11.89% in 2022. In the UK, they moved rates up indeed 4 times this year because inflation has moved up from 1.8% to 9.1% as at the last time that data was released. Of course, in Egypt, coming to Africa, they have increased their rates 3 times this year, because in 2020 the inflation rate was 7.3% and today is 13.2%. Ghana has increased rates 3 times this year. Inflation had moved up from 7.8% in 2020 to 29, almost 30% today. Whereas in Nigeria, what we have done in our own attempt to pursue a policy of price stability that is conducive to growth, we have tried over the couple of meetings to leave rates the way they are, while at the same time we have been pushing hard on how to improve on output growth. But of course, with the aggressive acceleration of inflation rate in Nigeria, we decided in May, after almost about 2.5 years, to raise rates by 150 basis points. For our own review, if we have to conduct a comparator analysis, in 2020, Nigeria's inflation was 12.13%. Today, the last data released just about a few days ago puts inflation at 18.6%. Monetary Policy Committee members feel that we cannot just continue to watch inflation grow the way it is rising, that something must be done to rein in inflation. We conducted a very serious analysis looking at various data that were presented to us at this meeting. And we felt that there is a need, not just because we want to look at what other economies are doing, but also the fear that whereas we are seeing some output growth as a result substantially of what we are doing in development finance, but that we need to really rein in inflation. We need to do a lot more work on inflation. And that is the reason, like I read at the communique, whether to tighten or to loosen on hold, MPC did not even take any look at the issue of whether to hold rates constant or to loosen, because we know some people would have expected that having tightened last time by 150 basis points, some of the analysis we've watched or read is that, look, we should not continue to increase rates because it will increase cost of borrowing, by borrowers, it may also weaken manufacturing output and the rest of them. We agree with that postulation. But the important thing is that at a level that can retard growth, it must be dealt with, while at the same time we're looking at how do we use development finance tools to continue to push towards improved output growth. That is what we're doing, and I believe, and I want to signal, determined if inflation continues at this rate, particularly aggressively, we would continue to tighten, because that is the only thing that I can say at this time. So whereas we're doing everything possible from CBN to look at the various other measures that can be used to moderate inflation, improving farming, hoping that farming outputs will be better, hoping that with that, when the harvest eventually sets maybe sometime around August or September, let's even say September, October, we may begin to see a moderation in food prices that will help to see to a moderation in inflation. If we do not do so, I cannot promise, MPC cannot promise anybody that we will not continue to increase rates. The second question from this day talks about the RT200 as well as the 100 for 100 updates. I read at the communique, and MPC was very delighted that 100 for 100, we're making progress. I think we've discussed, which is meant to really drive support for those who want to produce goods that can be exported out of the country to earn dollar revenues. Indeed, we are delighted that the raise to $200 billion is yielding good results, the RT200, because the data that we have so far, and I read it in the communique, we found out that we received inflows as of June this year of almost over $2.9 billion. And you all know that during the first quarter when we started, we disbursed 3.6 billion naira as rebates for those who have conducted export activities. For quarter 2, we have this morning just approved the release and payment of rebates to those who conducted export activities to the tune of 20 billion naira for quarter 2. You can see a jump from quarter 1 to 20 billion in quarter 2. This is because whereas we found out that yes, there's been a lot of export, but those exports that were found to be eligible for the rebates were in the tune of over $600 million. And that is the reason we're paying slightly over 20 billion naira during the second quarter. We are very, very happy and delighted that a lot more people are embracing export in Nigeria. And indeed, not only that they're embracing export, but as a result of the incentives that we're providing and the incentives that are being paid promptly, that revenue export earnings are increasing, and we had hinted that at some point we would get to a point where the banks will not even need to come to the CBN to buy foreign exchange to meet the import needs of their customers. We're delighted that we're moving gradually in that direction, and I'm optimistic that these numbers will improve by around the end of the year. Now, leadership talked about e-naira. Up till very recently, like you know, Nigeria is the second country in the world that launched its digital currency, the CBDC, called the e-naira. And I can assure everyone that we're making tremendous progress there. We will admit that there is a need for a lot more enlightenment for e-naira, and that will continue to go on. We're going to send some of our people to go out to enlighten people about the benefits of e-naira. And I must say that the e-naira is I use the word, either costless or the product that has the lowest cost in terms of you moving money electronically from one location to another location. In terms of our body, we have been focused up to now on the banked population. We are almost concluding tests with MTN to provide a channel where the unbanked can onboard using the code *997##. We believe that once this is done, we're going to be targeting the unbanked population. And we're also going to be using agency banking arrangements available and other means to ensure that we drive down our e-naira product. Today, I'm aware that people are now using our e-naira on remitter.net to make purchases. You can make payments for your DSTV using our e-naira. You can pay government bills. You can buy airtime, and you can conduct a host of other transactions through our e-naira at the lowest possible cost. And I want to advise you. You may go to your bank, they may be a little bit resistant to you because moving that money from your account into your wallet is a disadvantage to the banks. I want to say so boldly and bluntly. It's a disadvantage to them, and again, it is almost costless, at least today. So you should go and tell your bank you want your account to be, your INR to be loaded onto your wallet. It will cost you little or nothing compared to those other products that you have that will cost you money in the bank. I will say very bluntly, I'm a banker myself, there is apathy by them because of some income. So you should insist on using your wallet to do your transactions. The fourth question talked about election spending. What we do is that from central bank we monitor liquidity in the system, and as we see that there's excess liquidity, we will continue to use our discretionary powers to move those liquidity from the vault of the banks so that they do not get involved or in speculative activities with people who want to speculate. As for those who want to buy, take naira from their account to buy dollar because of election, I want to warn, not advise, that it is illegal to do so, whereas it will sound more convenient that you should carry dollars because you can carry just little dollars but with a lot of value in your pocket. But if the security agencies hold you, you know the implication of that. We would continue from our own side. We have our own apparatus through which we monitor movement of funds between customers or between banks and customers or from one bank to the other bank. And any bank that will find in those kind of transactions that we consider to be unauthorized or that we consider to be illegal, you can imagine that your account will be placed on PND. What does PND mean? Post-no debit. When your account is placed on post-no debit, it means you will never be able to conduct banking transactions in any bank in Nigeria. It is a very injurious tool that the central bank uses. You can see, central bank has turned itself into a monster that uses an injurious tool to stop you from conducting illegal flows, whether domestic or foreign currency. So I will advise you not to get involved in unauthorized and illegal movement of money from your bank to your account or from one account to another account or in currency conversion. When you do that and you are caught in that practice, your account will be placed on PND. A couple of people have come back to us to say, oh, our examiners that placed the account on PND were not very accurate. And I said, it is not possible. Before we do, we conduct a thorough investigation. We have proof to see to what you have done illegally. And your account will be placed, you will be barred from conducting banking transactions all over Nigeria. I would advise that we run away from PND because it is very, very dangerous to get into that net. Talked about that we've listed a couple of interventions. We've done a lot of interventions in the health sector, agri sector, and many are keen to know the impact of these interventions and the status of repayment of these interventions. But I think I will say this, that it is to the credit of the Buhari administration that we have, through these interventions, helped to impact positively on the lives of Nigerians. Yes, we have. During COVID-19, beginning around the period of the pandemic, we unveiled a couple of products. Is it the targeted credit facility, where people who are impacted, who could not work, who could not earn a living, got some little money, 400, 500,000 naira, to set up their small businesses? Is it the AXMIS, where you want to set up a hairdressing salon, or a sewing business, or a barber shop, or a block making factory? You are able to access finance and you don't have to know anybody in CBN. to access this facility. We have done a couple in agriculture, we have done in healthcare, all to see to how we can be less reliant on imported items. We have tried as much as possible to provide intervention to people who are producing goods that should be produced in Nigeria than importing them. We have succeeded today in stopping the importation of rice. When I became CBN governor, we were importing maize into Nigeria. We were importing all forms of cassava into Nigeria, cassava starch, into Nigeria. We've started a program of reducing the import of wheat into Nigeria because we are aggressively also now ramping up on the production of wheat locally. That is why I say it is to the credit of Buhari's administration that this is being achieved. It is also the credit of the administration that by the end of this year, or very latest first quarter of 2023, Nigeria will begin to produce its own refined petroleum products, whether it is PMS, it is AGO, it is aviation fuel. We will begin to refine and then begin to sell our own, in which case the price of all these products will be lower. We will not need to continue to import them with scarce foreign currency. I have often said that the dollar value of how much the PCBN spend on an annual basis to import petroleum products constitutes close to about 30% of foreign exchange that is needed for imports in Nigeria. By the time you add FX needed to import, whether it's rice those days, or it's maize, or it's cassava, or it's sugar, or to some extent wheat, we almost close to about 40 to 45% of what FX that is needed to import these items are on this go for these products. And I'm saying again, it is to the credit of this administration that by the time the president bows out next year, these products will be produced in Nigeria. They are being produced like the agricultural products. So a lot has been done. What is the impact? The impact is that, for instance, under agriculture, the bank's intervention has financed over 4.1 million farmers, cultivating 21 agricultural commodities to the tune of 1 trillion naira across the country. What did that do? Not only that we stop importing those produce, agri-produce, but we are creating employment for our people. Is it through the Anchor Borers program, which has contributed over 4 million metric tons to our national food production in 2021? The Anchor Borers program has also created over 12.1 million jobs since its inception in 2015. So when you begin to talk about impact, those are some of those impacts because it has also helped to create employment. Yes, you will say that if this has happened, why is unemployment rising? But please don't forget that Nigeria is one of the countries in the world with the highest population growth rate. Nigeria's population grows by at least annually. By 2050, Nigeria will be the third most populated country in the world. Third. No doubt it places a lot of responsibility on leadership to provide for these people. But to say that the interventions have not been impactful because unemployment is rising, then I will always tell people, you would have waited to see what would have happened to us if we did not do this intervention and what would have been happening to us today. It's not that we're happy that some of the things happening today are happening, but I can assure you that they would have been warned. In the bankers committee meeting, I said, we all have a joint responsibility to see what can be done to improve level of employment in Nigeria, reduce unemployment in Nigeria, because we all cannot continue to wear our suits and our beautiful skirts and gowns and think that one day, if unemployment continues to rise, if we cannot provide for the basic needs of the downtrodden, one day we will not be able to sleep in our homes. That is why we remain committed at the CBN. That is why at every meeting, either at the CBN board or at Monetary Policy Committee or the Committee of Governors, issues about how do we reduce employment, how do we impact the lives of our people, those are issues that are very, very germane to us, and we take them seriously. Or are you talking about in the health sector? In the health sector, but I can also give some of the numbers to you. The bank has released over 130 billion naira to 129 projects across the country, comprising 76 hospitals, 32 pharmaceutical companies, and 21 other healthcare services. Before now, it used to be so very difficult for people to conduct simple MRI. There used to be only one company in Nigeria. They talk about so a company that used to be at Oshodi. What's the name of that company? Mekio. Mekio used to be the only prominent company that has MRI machine in the whole of Nigeria, a country with a population of 200 million people. How then would we say that people should not go for medical tourism abroad if they need simple health care to solve problems for them? Today, we have supported the acquisition of 59 MRIs, magnetic resonance imaging machines in the country. We have supported the funding of 42 computed tomography CT scanners and 4 oncology screening machines in hospitals across the country. So when you ask us questions as about the impact, I would wonder. I have told our colleagues at CBN, they should try. It's not a fluke. When we advertise our interventions, we put the name of the intervening institution or person. We put their telephone numbers because we are confident about what we have done. And we tell you, call those sources, they will tell you. We do not have too much money to continue to be on pages of newspaper and television because these are too many. But we know so that Nigerians can see what we are doing to improve the well-being of our people. We have often received criticisms from people about the repayment of these loans. Under repayment, interventions in the agricultural sector, this has improved significantly because people believe that people are not paying. As the bank has adopted the collection of produce, instead of asking farmers to give us money back as repayment, we have our development finance officers that are there almost at the farm gates to collect the produce, and then we sell it ourselves to recover our loan. For example, out of 741 billion naira that we have disbursed under our commercial agricultural credit scheme, 548 billion has been repaid, both in principal and interest, and the balance of 196 billion is indeed not yet due. So when people say that our interventions are not being paid, I wonder where they are coming from. Yes, sometimes people will take loans and they won't pay. And we have often said it, that when you take a loan, the times are gone when you will not pay. Because we have also put in place various schemes where we will monitor where you are keeping your money nationwide through our global standing instruction, the GSI. And wherever we find your money, we will take it to repay your loans. We have started an aggressive collection of those loans. And I'm optimistic we'll collect them. Unless you collect the money and you keep them under your pillow. And you know the risk of collecting your money and put it under your pillow. Either somebody will steal it or somebody will burgle your house. I don't pray for people to burgle your house. But you know that it's risky. So put your money in the bank. If you are afraid that when if you pay, you put in the bank, they will collect your money. Why will you then take a loan and must pay? And you. So we are determined that we have enough instruments to ensure that you repay your loan. The last question talked about our intervention in Dutchess, which is in the healthcare sector. I think first, let me seize the opportunity to wish His Excellency the Vice President well and a quick recovery after his successful surgery at Duchess International Hospital here in Lagos. I thank the Vice President because what he has done is to set an exemplary example to say that in Nigeria, you can go to a hospital and get treated no matter how highly pleased that you are. In fact, and I will also say it is to his credit, that when Reddington, which also owns Duchess, applied for a facility through Guarantee Trust Bank, I think Guarantee Trust or one of the banks, to CBN, we were even then a little bit reluctant. We said, what would the revenue be? What would the collection be in a hospital and the rest of them? Is this not excessive risk and the rest of them? But of course, with his insistence, we granted the first facility. Reddington Hospital is there for you to see in VI. Now, we granted a second facility. They set up the Duchess International Hospital. We commissioned the hospital last year in Lagos. I was there to see it. And I'm sure Duchess is an example of the world-class, state-of-the-art hospital facility. Duchess has brought, from time to time, they bring in our specialist Nigerians from the United States, from the UK, from all over the world to come and conduct some of the most complicated surgeries here in Lagos. I'm aware of a professor of heart surgeon. I know it's Professor Adeleke. He brought in, that Honorable Ali brought in from the United States. We went through the cat lab or whatever machine that they brought in at various stages. Today I know that the same professor has set up his own private hospital aside from Duchess, where he also conducts surgeries on heart. We have several people who are doing things that are never done in Nigeria today. What is our own interest? Our interest in this is that it reduces medical tourism. Medical tourism today in Nigeria consumes nothing less than $10 billion. Am I correct? Did you? At least $10 billion is what we spend in a combination of tourism. Nigerians now go to school shamefully in some of our neighboring West African countries, and they pay dollars. And that is the reason I do understand the feelings of ASU, the feelings of our lecturers, but they need also to know that by keeping these children at home, their parents looking at them, it is a dangerous trend that we all must place our hands on deck and see what can be done to stop what is happening in educational tourism in Nigeria. But again, I must say that I'm happy that there are very, very strong private universities that are sprung up in Nigeria, and we can only just continue to encourage them so as to continue to lift the standards of education in Nigeria. Let's not forget, ladies and gentlemen, people say that health and education are the bedrock of development of any country. We cannot afford to relegate them to the background. So everything that needs to be done to improve the level of health, care, and education in Nigeria, we should all put our hands on deck to get this done. But I repeat, the selfish interest of CBN here is that we need to stop medical and educational tourism in Nigeria. I thank you very much for your attention.